Hello and welcome to episode 13 of BuiltPlace's Housing Conversations. Today we're going to be having a look at the mortgage market, and I'm delighted to be joined by Peter Williams and Andrew Baddeley-Chappell. But first of all, we're going to have a look at a couple of charts just to set the scene. So the first chart we're looking at here is the mortgage approval data, and this has got the update from yesterday's release, which shows that on mortgage approvals for house purchase have actually rebounded back to their average of the last few years. And so it's definitely a V-shaped recovery in terms of mortgage approvals for house purchases at the moment. However, the remortgaging numbers remain very low, back in the kind of 2010-11 levels. And so it's not a wholesale recovery in the market. And just looking ahead, this is quite interesting data. Both Rightmove and Zoopla have been publishing information about the number of sales agreed, and we've overlaid the Rightmove sales agreed data here over the mortgage approvals for house purchase, and they seem to be a pretty good leading indicator for what's happening. And so it'll be quite interesting to look at next month's release to see whether that gap between the Bank of England actual mortgage approvals and the sales agreed closes, whether there's a continued bounce in the mortgage approvals, or whether actually it's indicative of perhaps more cash transactions that are happening in the market. And I suspect the cash transactions is quite an important part that is reinforced when we look at the pricing of mortgage rates by loan to value ratio, LTV. And we can see there, particularly for your 90% LTV mortgage, there's been a significant spike in the average mortgage rate for them. And that's closed up quite close to where the 95% is. And I suspect the 95%, although it's fallen in recent months, actually that's probably a reflection of a sample size issue. There's very few products on the market. Meanwhile, mortgage rates around 60% LTV remain broadly where they have been for the last few months, and very cheap compared to historic trends. So on that, I will bring in our guests. And I'll remember to change my camera over as well to avoid the problems there. And so, good afternoon, Peter and Andrew. Thank you for joining me. There's clearly the mortgage market looks like it's bounced back, but there's problems there. And we've just heard HSBC are pulling their higher LTV mortgages. What's going on? Is it growth? Go for the boom, lend lots, or are there bigger problems in the market?
If I may just start, clearly most lenders have got access to the Bank of England's scheme to borrow relatively very cheap money, and clearly there's a considerable appetite to lend on the back of that. So lenders have been very active in using the Bank of England money, which allows them to borrow at, I think, 0.15%. and then lend out on the market. This is good times for mortgage lenders, that is for sure.
Yes, but also they're obviously being selective, because for a start, their risk committees are clearly going to be asking them some very challenging questions. And of course, that isn't just about the market now. That's about the market in the 3 to 4 months that a completion will take, and then the life of that mortgage beyond. But I think there's another dynamic as well, which we've seen, and I saw back in 2007-8, which is once the market starts to retrench, even if your appetite is, or your willingness is to continue to lend, you often physically can't continue to do so, because you will be swamped with a volume that is chasing a smaller number of lenders, and in effect activity gets forced on you. So as well as seeing what we've seen, which is the withdrawal of higher LTV products, we've also seen more subtle changes by lenders to naturally limit the amount of activity that they do, even when they keep products out there. So lenders are often, I think, happy or to continue to lend, but are trying to get that balance right. And so we've seen, a classic example is having seen mortgage terms extend to 45 years. It's now become a common feature to see the lending at higher LTVs restricted to 25 years. And clearly that's in part about affordability, but it's also about simply keeping a product out there, while at the same time being able to restrict the access to that product. And we'll see similar things with focus on existing customers and other areas like that as well.
Yes, I think we've got this, Neil. We've got this interesting kind of conjunction of exuberance and caution all at the same time, as Andrew's describing, where in the short term, people are keen to rebuild their business plans to achieve the targets they set themselves, at the same time looking ahead to be concerned about what's coming down the line. And it's this kind of curious mixture of caution, at the same time very active. And I suppose we accept the long-term picture is more difficult, but focusing on the short term, Andrew, I think everybody would be pleased to see the mortgage approval figures go up as strongly as they have, for that recovery to be so well moved ahead in the way that it has.
Yes, and I think if we look at the underlying features of the market, then the position for individuals remains strong. Mortgage rates are historically low. We haven't seen the expansion up the risk curve in the market, so there's not a large amount of risky lending doing. It's largely all on repayment mortgages. We've had a period of extended, not large but sustained house price growth, so LTVs of the existing books are going to be looking pretty good, and of course the customers can retrench back to lower rates, and even if customers are unable to service their debts, they can retrench back to first of all to interest only, and then after that even if arrears are building up, they're building up very slowly because the rates on the mortgages are so low as well. So they have an increased capacity to last for longer. Same position with lenders. They're not in the position of necessarily being able to or need to exit contracts early to bring cases to repossession, to bring around the forced sales that will result in house prices falling as well. So and then we've got the continued shortage of property and housing in the UK. So, conditions are remarkably robust. Lenders have much greater levels of capital. The Bank of England still has more action to move. It's talked about negative interest rates. So there's, it's always hard to say things like this, but there is continued strength right across both lenders and individuals.
The question, for me, part of the question is whether the momentum that has clearly been built up is going to be sufficient to carry the market forward in a positive way over, let's say, the next 6 to 9 months, which is obviously a discussion we'll come on to. But Neil, I don't know whether you had any thoughts on the remortgaging numbers, which are disappointingly low in that sense. And it says there's something there about, we've got obviously the bringing forward of demand that was being pent up over the last, really pre-Brexit vote, plus the stamp duty incentive has brought forward demand. That looks like it's been mainly about house purchase and people moving, but the remortgage market has stood static, really. Or indeed, I think in that graph, I think did it slightly decline. But it's not moved in the way you might have expected. People aren't moving, but presumably that's because most people are on good long-term rates. They don't need to remortgage. There's no particular pressure to do so. Some people may even be in a position where they may find that their criteria are not viewed as favorably now by lenders going forward as they've tightened the mortgage market. So the remortgage market, which historically has been quite an active market, has slumped while the purchase market has moved ahead.
Yeah, and one of the, I'm not particularly sure, and I should know, is whether the remortgage figures include activity where it's a change of mortgage within just on the lender's books. So that
I don't think it does.
So that could be one factor in it. And apologies,
yes.
I really should know that. But so
yes.
It's possibly the case.
Those are called transfers, aren't they? And I think the transfers are separately accounted for, but that's something we need to look at.
Yeah, so it's possible that there is more activity happening, but it's happening
Yeah.
within lenders. So that retention of existing customers, maybe lenders are being more competitive and trying to hold on to their existing borrowers. There's also the shift to longer fixed rate periods, which we've seen in recent years, which will have played a part. So increasing use of 3 and particularly 5 year fixed rate periods, which will probably dampen activity for a period. But yes, the activity is low, and it'll be interesting to see how much of the recovery in the house purchase is merely delayed demand from the lockdown period, and how much of it is, as you say, sustained through over the next 6 to 9 month period. It's interesting in the sense that if you look at the makeup of the overall housing market, mortgaged home movers having once been by far the dominant buyer group within the market, have remained stagnant over the last 9-10 years now. And so it's interesting to see that all of a sudden actually there is a lot of talk so far. Unfortunately, we can't get the data anymore publicly, so we don't know exactly what's happening, but it does appear there's more movers happening, and that appears to be bringing more supply to the market itself. So kind of with people moving and then deciding to then list their homes. I've heard anecdotal stories about agents not talking to potential viewers unless they've already got a home listed on the market. So there's some interesting things happening that could be a shift. And this, we've been through a life-changing period where people have reassessed housing, and it could be that actually we're seeing a shift towards people moving house more in search of what they want, and so remortgaging inevitably is a smaller part of that. There's also perhaps a period of people just still being cautious about the future and not necessarily wanting to extend themselves and take out more debt, despite the fact that rates are cheaper. But it's from the mortgage lender's perspective, there's clearly there's both. You don't want to, and I think we can look at it much wider in the housing world, apply it to house builders and others. There's a desire not to miss out on what's happening at the moment, but then there is a great amount of caution, if not fear, about what the future holds. And
yes, so it's striking that a number of lenders have come back into the market now. I mean, that number, Dudley Building Society, I know Vida Home Loans has come back into the market. There will be others who are ramping up what they're doing. So volumes of product coming to market are increasing.
And I don't think we should underestimate the effort that is taken from lenders to deal with the huge volumes coming through in relation to furlough. Also, the other classic with remortgages is, and I'm sure lenders have prioritised existing customers first, as they should do, and home movers and others as well to some extent. Remortgaging remains a slightly cautious and potentially challenging task because of the furlough position. So it's kind of it's an interesting. It's normally been a very quick and very automated process, but I do think that some of those automations may be struggling at a time when data is not keeping pace, or where information about employment is not as freely traded or as certain as it was. So if I were a lender, I would certainly be cautious about or putting the remortgage market lower down in my priority, except of course where there is high quality business. But then as we've already discussed, that the margins down there haven't recovered, and they were extremely tight before this. So it's a place where you will go, but there's not a lot of money to be made, even if the risk is low at those low LTV cases. So I'm not surprised to see that picture. I think the other picture that we saw in 2007-8, which of course is a lifetime ago for some people, but we saw consumers were very bad at actually choosing the right time to interact with the market and necessarily the right products to choose. They sat there for a lot longer than they should have done in many cases, and were more reluctant to move because of the uncertainty that existed, either because they thought there were better times coming or better products coming if they waited a bit longer, or just because in the absence of knowledge and insight, they chose to sit tight with where they were. So I think that was also a feature that appeared last time round.
And of course, government is still searching for the holy grail of people taking out very long-term fixed rates. While at the same time, the bank is signalling that fixed rates that low rates will remain in place for a longer time. So there's no reason, in some senses, for people to go out and seek in the market 10 or 20-year fixed rate mortgages when they can buy a 2 to 3 to 5 year fixed rate in the knowledge that the likelihood is that the market rate will remain low anyway.
Yeah. So I suppose lenders are understandably being cautious in the market at the moment, and it's no surprise that we're seeing the trends happening around criteria and rates and the availability of not just LTVs, but as Andrew said, mortgage terms, and we've seen poor credit histories or what been on furlough, and so but that's clearly that will be creating divergences in terms of activity and where the market is active and not active. And
yes, and of course on that, Neil, there's one of the great questions about furlough and payment deferral or payment holidays, as people call it, is that quite a lot of people opted into that scheme because they, quotes, were offered a holiday. Of course, lenders have got to unravel the question, did they need to take that holiday, or was it simply because, quotes, it was a free good? And that's obviously going to be a question that they're going to have in their minds when these people reapproach the lender for further mortgages, because there is obviously a question about whether their underlying position is weaker than it was previously.
Yeah, and so it could be a whole new generation of trapped mortgage holders.
I think I totally agree. I think there's the mortgage prisoner issue is normally associated with closed funds, but actually when you get a radical change in criteria in the market and assessment in the market, you potentially park segments of borrowers who can no longer access the market, and they therefore become, quotes in modern jargon, mortgage prisoners. And that seems to be the threat at the moment. We'll see further generation of prisoners.
I think the other area where we may see prisoners is housing market. We've already talked. We mentioned about people moving for lifestyle choices. There's also, I think we can be fairly confident to predict structural change accelerating in high streets and offices, which were trends that were already happening. But I think we will see some continued trend in housing linked, actually, of course, bizarrely to both those things, because suddenly people can afford to work further away from the office and can be effective in doing so. Of course, everyone that's selling to move somewhere has to find a buyer for their own house and someone willing to sell the house they're buying. So I don't think you can automatically assume that just because people want to, they'll be able to. But I do think that there will be a number of homes coming out of this, as and again, I would go back to even further back to the 92 downturn, where it was the flats above chip shops and houses that were extremely difficult to shift, the ones that first time buyers bought because they were the only ones they could afford to.
And the price data, Andrew, supports that. It's already showing the stronger price growth is in semi-detached and detached, and the weaker price growth is in flats and converted houses. I think the question will ultimately be, and I'm sure Neil will be tracking this closely, that the question will be how far this translates into a mass movement as opposed to a relatively modest movement. And that's the bit we just don't know.
Yeah, it's possible we're going to see further kind of split in the housing market, and it's a topic that Yolanda Barnes has talked about a lot. Kind of your quality of the housing in terms of both its physical structure, but then also its location and the amenities that it has, and this could be a wholesale repricing of that, with desirable places continuing to see strong demand, rising prices, lenders willing to lend on them, and other homes at the complete opposite end of the spectrum. And we're actually seeing that already with kind of new build flats, particularly with concerns around leasehold and cladding issues and things like that. So we're already seeing some of that come through the market, but it's potential.
There was a rather pungent comment in one of the weekend papers where a person was commenting, this was about a US market where the same feature is arising, but saying all the reasons why I should stay in my inner city location have gone down, and all the reasons why I should leave it have gone up. In other words, the reasons for staying were things like restaurants, clubs, entertainment, all of that was less available. And all the things that increased, like litter, pollution, even crime, potentially going up because the streets were less active, they were reasons to leave. And you can imagine that having some momentum in the UK.
Yes, definitely.
And the other area, sorry, I was just going to say, is some of the marginal buy-to-let lending areas as well, because there are people that have in lower paid work that are choosing to live away from home potentially, that are more likely to return to home for some period. And again, I think those properties do present a higher risk. And it is interesting that it does seem to be that the buy-to-let market has not recovered in the same way that the house purchase market has. And I think that we haven't faced the buy-to-let market hasn't faced a tenant shortage in its entire life cycle effectively so far. So even in 2007-8, the general pattern was employment continued rather than wage growth. So companies took moves to retain employees rather than to raise wages, and that presented a kind of shared sharing across society that helped the economy to recover from those difficult situations. But this time round, that isn't necessarily going to be the case.
No.
There are going to be long-term removal of some retail and entertainment spots, or at least for a period beyond which people will need to act. And I think that seems to be one market that may be challenged.
Well, and the somewhat alarmist estimates at the weekend about the number of tenants not paying their rent, I think it was 600,000, and obviously with the ban on evictions, where this could push landlords into certainly 21 before they might be able to recover their properties. That does begin to create certain considerable uncertainty in the buy-to-let market, and certainly from both a landlord and indeed a lender perspective.
I suppose one of the converse of that is, in terms of the demand for rental accommodation, is the pressure on potential first-time buyers now. And we at least half of normal numbers are probably now excluded from the market based on previous LTV trends, and it may even be higher than that. And so we're clearly going through a period where there's a credit crunch for first-time buyers. They're unable to get into the market, and that will drive some demand for rental accommodation in particular locations. But it's difficult to know then how that is balanced against the kind of how many people decide to live at home, and then there's the big uncertainty around what's happened to international students and other people who have come from abroad. Has there been a big change in population? Did a lot of people leave the UK to head elsewhere as we lock down? We don't know yet. And
it does seem to me that age cohort is facing real pressures both in the labour market and the housing market. And how you recover that, I'm not quite sure, because time will help. But if jobs have been lost and wages have been shrunk, it's that cohort in particular probably that face that difficulty. And similarly in the housing market, it's that cohort that are facing some of the difficulties, reflecting the contraction of lending appetite, certainly a high LTV. So all of that creates significant pressures for that group.
Yeah, and it's going to become a political issue. Well, it already is. It's increasingly so. But it's as we see more people excluded from home ownership, the pressure is going to grow on the government to do something about it, and inevitably that will feed through to what the pressure that lenders feel. Is there anything that government and or lenders can do at the moment, given the uncertainties we have?
Well, I know the housing minister has reiterated again the government's intention to close the Help to Buy scheme in 23. Some people have obviously argued that's a salvation that should be sustained, and I think the First Home scheme, which will have a pilot, there are no expectations that's going to become a mass substitutable product. So at the moment, there's no obvious, as far as I can see, there's no obvious solution in sight from a perspective of government solutions.
Yeah. No, I mean, I do think we need to be very careful, because when we typically talk about the issue of affordability, it's very much a London and South East area. So there still remain parts of the country where, particularly a young couple buying together in reasonable jobs, are able to afford a home. So I think that we talk about the rebalancing and the refocusing activity, and it may be that the increased mobility within the country, or the increased ability to work outside London and the South East, may result in firms being more willing to think about allowing people to operate and work from areas where housing is cheaper. So I think actually I would say that's the greatest intervention that should happen, may be able to happen from the market, and that is the attractiveness and the availability of activity, with some government support that's been promised to the north. That those areas might actually begin to gain, and suddenly the dynamic where land is, of course, we've got a strange dynamic in a way that in the north in particular, there is land and homes that can, even new homes that can be built at a more affordable level. It's just that we don't tend to, because the value uplift on the land that in particular the developers seek isn't deliverable in those kind of areas. But by that same token, if you are able to deliver homes there, they can be more affordable and more accessible. So there's more to play with, particularly on a regional basis.
This is probably a 5 to 10 year transition. It's again into the longer term, isn't it? We begin to see the seeds of this happening. The question is the scale and the momentum that builds up.
Yeah. And Peter, you mentioned Help to Buy equity loan there, and the suggestion there's not going to be an extension. Yeah. And over the weekend, someone spotted on the nationwide intermediary website the list that was, I think it was 70 pages long, of new build schemes that Nationwide won't lend on. I don't know whether that's larger than normal, but it struck me as quite interesting, with a lot of city centre areas in the Midlands and North being kind of excluded because of risk concerns, which understandably. And if Help to Buy isn't extended, first homes is going to be minor, then actually that this period of concern and limited lending criteria, particularly on new build, particularly for first time buyers, that's going to have quite a big impact on new supply, and the government's aspirations around that.
Yes, and you can see house builders beginning to kind of build in that adjustment, and obviously, although the government continues to argue supply, the building model, as we know, the absorption rate, as Oliver Letwin would have us, they will only build at a rate where they can sustain current prices. So we're not going to see an acceleration in supply.
Government's going to realise that demand is just as important.
Demand is just as important, yes. And at the longer term, I think, so much turns really on the recovery of the UK economy, and obviously that includes the Brexit scenario, and the level of uncertainty is very, very considerable.
So based on that uncertainty, it appears likely that these conditions are going to continue for some time.
that would be my assumption. I think we're certainly looking through to the end of 21 before we've got any clarity on where this is all going.
Yeah, and in a way, I mean, I think we can be really clear that we're entering a pretty high risk period, which is the period from, the ending of furlough through to a potential vaccine, with Brexit in the middle of it. That is not a nice scenario. Of course, it's a less bad scenario if we can be fully confident a vaccine will be out, will be effective, can be delivered, and we know when it's going to arrive, because then I think you can start to plan. I think that the hardest scenario would be the plan where the vaccine drifts. Do you know what I mean? Because if you know there's a set period and you can be confident about outcomes and you can be confident that outcome will be a return to normal, then you can plan. But a vaccine, vaccine that you think will be there in March that then doesn't turn out to be there till December is really, really bad news, because your plans and assumptions work on a different. And I think that's, that to me is the information that we don't know about, that the government will be having to think through in the run up to the budget. We got the spending review at the same time. Yeah, this
one thing I think we can know, and this is a question as much as an answer, Neil, is that we're not going to get a big rise in possession cases and a whole load of forced sales onto the market. I think, history tells us that governments have intervened on that over the last 20 years, certainly, to manage the risk of the spiraling housing market downwards, where it ratchets worse and worse upon itself. I sense, and Andrew, I think you're agreeing, that we'll see intervention by government as well as intervention by lenders to sustain the housing market through this next 18-month period, regardless of the difficulties that may arise.
Yeah. And of course, that in itself has its own impacts, because it's falling house prices that make new homes affordable to first-time buyers as well. So it suggests a protection of a continued policy that's gone on since, well into the last, it was in the last millennium, where and again, this was my message. And the 92 crash was the crash that really hit the first-time buyers, where house prices fell rapidly. People had overbought and faced extended periods and large losses, and were largely left, to be honest, by the government to deal with it themselves. To work themselves out of it. We've gone away in many ways from a society where individuals take the risk and the consequences to one where everyone needs to be looked after. The problem when you look after everyone that's in the housing market is you, almost by definition, don't look after those who want to be in it but can't access it. So it's good news for house owners, and it's good news for those with existing equity and for an older generation of people, but it isn't bringing about the structural change that will make it easy for that generation that's struggled now for nearly 20 years to get onto the housing market, particularly in the southeast.
Andrew, I think that was a perfect summary and an opportune time for us to wrap up. So thank you very much, and thank you to both of you.
Thank you.
Yes.